global cryptocurrency market is in some serious trouble right now. Bitcoin crashed below $21,000 on Wednesday, dropping a further 10% overnight to reach its lowest level since the end of 2020. The cryptocurrency has since recovered slightly, though analysts warn that the volatility may not yet be over. The latest losses mean that the price of Bitcoin is now more than 70% since its all-time high in November 2021, though previous major downturns following then-record highs in 2013 and 2017 resulted in corrections of more than 80%. The overall crypto market is also down below $1 trillion, following similarly heavy price falls for other leading cryptocurrencies like Ethereum, Cardano, and Solana. Major platforms including Celsius and Binance have experienced operational issues this week, which they blamed on an influx of investors liquidating their assets. Crypto exchange Coinbase has also announced that it is culling over 1,000 employees after previously rescinding job offers. However, Binance has announced it is hiring 2,000 more staff. Hello and welcome to Smart Tech Ideas. In today's video, we will update you about the cryptocurrency collapse as Bitcoin losses top over 70%, the reasons behind this market stress, and how will Bitcoin recover after this catastrophic selling climax. Make sure to stick around till the end of this video, where we will discuss the key situations that can arise if Bitcoin falls below $20,000 price level. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. So without wasting any time, let's dive right into the video. As bearish sentiment floods financial markets, experts are weighing in on whether Bitcoin will plunge below the $20,000 mark or not, and what might happen if it does. Bitcoin, now firmly in a bear market, is currently trading at just above $21,000, a remarkable fall from its all-time high price of nearly $69,000, and a drop that most observers attribute to worsening macroeconomic conditions, such as rising inflation and interest rates. At the moment, all eyes are on the $20,000 price line, not only because it's a significant psychological support level, but also because it represents the peak of Bitcoin's last bull run in 2017. Digital tokens are in free fall as fears of climbing inflation, aggressive interest rate rises, and liquidity issues at a key player in the crypto space have plagued crypto markets. The Federal Reserve raised rates by 75 basis points, as was widely expected. Chairman Jerome Powell also signaled that another 0.75 percentage point hike could come next month if inflation remains high. In prior bear markets, Bitcoin has never fallen below the price marked by the previous bull run's peak. The difference this time, however, is that Bitcoin has a lot less distance to travel to cross that mark. Based on experience from previous bear markets, it's possible that Bitcoin could drop more than 80% from its all-time high, as it did in December 2018 when it fell to just above $3,000. That would mean Bitcoin falling as low as $13,800 this cycle. It's important to note that Bitcoin's investor base is very different and more sophisticated compared to previous bear markets, and if Bitcoin dropped below $20,000, we would see substantial buying pressure at those discounted price levels because Bitcoin's long-term value proposition remains intact. The controversy surrounding crypto lending company Celsius, the possibility that the company may be insolvent, and the apparent liquidity crisis that forced it to pause all user withdrawals earlier this week. Celsius is in big trouble, and if the whales who have leveraged bets on Bitcoin and Ethereum get liquidated, this would result in further downside. In fact, many are fearful of a liquidation cascade occurring with the likes of Celsius being margin called, and now having a liquidation price of around $17,000 on their Bitcoin position. Within the crypto sector, investors are also awaiting briefings from two industry players, Celsius Network and Three Arrows Capital, as well as other firms exposed to their books to gauge if they risk solvency issues, which have sparked contagion fears. Coinbase's reduction in staff shows the dangers of relying on holding on for dear life instead of a calculated approach to the crypto industry. Investors and pioneers have failed to factor market volatility into their business models, which is an oversight given that volatility is an inherent component of this young market. It's clear that both investors and crypto pioneers took a hodl approach instead of one that represents a more calculated approach to this nascent industry. Just a day after Coinbase announced that it would be firing 18% of its workforce, totaling roughly 1,100 people, rival crypto exchange Binance has announced that it is hiring. CEO Changpeng Zhao known as CZ, said the company has 2,000 open positions, which he attributed to Binance not splashing the cash on expensive crypto ads and sponsorship deals during the latest bull run. These insane Bitcoin losses mean MicroStrategy, the world's biggest corporate investor in Bitcoin, is now down more than $1 billion from its initial investment. CEO Michael Saylor remains adamant that the firm won't sell its holdings and that previous concerns on a margin call on one of its loans were overstated. After spending nearly $4 billion on its stockpile, MicroStrategy's Bitcoin is now worth less than $2.7 billion. Advocates would say that the USD value may drop, but the number of Bitcoins remains the same. Since November, the Federal Reserve's decision to raise interest rates and offload its balance sheet has drained investor demand for crypto and other riskier assets. More recently, those tightening conditions have forced larger players in the sector to unwind positions. The shaky situation with crypto firms has muted a lot of the anxiety we would normally have with a 75 basis point hike. So far, Bitcoin remains above that, but ongoing inflation and the challenges fighting will likely continue to create weakness in crypto. Forced liquidations occur when investors must unexpectedly and involuntarily close positions on Bitcoin derivatives products after their accounts hit insufficient collateral to maintain those positions. This kind of forced selling puts additional downward pressure on the price of Bitcoin, which can then drive the price further down and in turn cause more liquidations, hence the cascade. The number of futures and options contracts yet to be settled are currently at $20,000 for Bitcoin and $1,000 for Ethereum. The closer the market approaches these levels, the more traders with open positions will need to sell their crypto in the spot market to hedge their positions. And if those levels break, we can expect massive sell pressure in the market. Will Bitcoin recover? Crypto hobbles into the week somewhat beholden to the whims of the stock markets, clearly on pins and needles over May inflation numbers. The U.S. Consumer Price Index report dropped on Friday. Its bottom line, not what anybody wanted to hear. Economists expected the CPI to rise 8.3% year over year, but the headline inflation level actually came in at 8.6%. Wall Street was groping for a sign that inflation may have peaked. Minutes before Friday's CPI report, Bitcoin was battling to stay above $30,000. Hours earlier, it was under $29,000 and now it appears to be on the verge of a breakdown below $20,000. A looming hazard of a crypto winter now hangs in the balance. Going into 2023, we expect major central banks to continue their trajectory of quantitative tightening and policy rate hikes, effectively limiting any significant upside unless we see more convincing trends in economic recovery. However, other experts remain bullish over crypto's future. Big Four accounting firm PwC published its fourth annual Global Crypto Hedge Fund report last week. The results showed that while the overall crypto market was quite bearish, managers remained extremely bullish on BTC, with 42% predicting Bitcoin to be between $75,000 to $100,000 by the end of 2022, and a further 35% predicting a price over $50,000. People invest at their own risk, and cryptocurrencies are not regulated by British financial authorities. All crypto investments are risky, but meme coins like Shiba Inu are particularly volatile, and you should be prepared to lose everything you invest. The Financial Conduct Authority warned in January, investing in crypto assets or investments and lending linked to them generally involves taking very high risks with investors' money. If consumers invest in these types of product, they should be prepared to lose all their money. On top of being extremely volatile, most cryptocurrencies are unregulated, which not only adds another layer of uncertainty, but also means that investors have little or no protection against fraud. So what do you think will happen next to crypto markets after crash is over? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.